So just like every other financial market across the world, munis have been impacted by the recent financial crisis in a number of different ways. Probably the most important is that the government entities with which issue munis have seen tax and revenue collection fall during the recession and the financial crisis. This has impacted different issuers in different ways. Clearly, any issuer, whether it be a government or a particular entity that's backing a certain project, which relies on real estate associated revenues, has probably been hurt a lot more than an issuer that has a broader tax or revenue base. But in general, revenue shortfalls have impacted most muni issuers. And this is in the news virtually every day when we hear about states or cities suffering budget shortfalls or deficits. The other important way in which munis have been impacted is that ratings issued by the three major rating agencies and the value of bond insurance has been questioned. So prior to the financial crisis, many bonds in the marketplace were issued with a financial guarantee by a bond insurer, which would step in and make principal and interest payments if the actual issuer defaulted on them in any way. And the value here was that these bond insurers typically carried AAA financial guarantor ratings, and so the bond could be sold as a AAA bond and could be issued at a lower rate of interest. Most of these bond insurance companies suffered during the financial crisis, and we very rarely see new bonds being issued now with bond insurance, partly because many of these issuers have been downgraded from AAA to AA, single A, sometimes triple B or even junk status. We are also very much more aware of default risk. Just like most other markets, the muni bond market had sort of forgotten credit risk existed during just in the period just before the financial crisis, and that is very much front and center right now. And there have been some high-profile defaults, some of which are listed here. The last way in which the muni market was impacted is sort of more of a temporary impact. Couple of areas of the municipal market saw a lot of turbulence in pricing around September 2008, and then again, the first quarter of 2009. And you'll see that in the two charts we've got below. One plots muni interest rates and it compares them with AAA treasuries, so the spread or the difference between the two. And then the next chart looks at 7-day variable rate demand obligations. So this is short-term paper where rates are set by auction, and this market saw a lot of turbulence towards the end of 2008. So the muni market was by no means spared by the financial crisis, just like every other financial market and security. Munis too are affected by a general decline in economic activity and growth. Now, to understand what's been happening more recently, we kind of have to go back a little bit and talk about the immediate aftermath of the market events that occurred in the tail end of 2008 and early 2009. So after the general stock market and most risky assets had been bid down or had suffered very sharp declines, we saw a flight into quality or what were perceived to be safer assets, and certainly munis and bonds in general were one of these. So rates and yields on municipal bonds fell to record lows. There was a lot of buying by investors who had not really invested in municipals in the past. Over the past probably 2-3 months since December of 2010, these record low yields have begun to rise, and there has been some selling. Outflows from mostly high yield mutual funds, both in the taxable bond space and in the municipal or tax-free space as well. We've also seen continued political and media focus on deficits, and some talk about a review of the tax-exempt status of muni bonds, and also some talk about the longer-term challenges that face states and municipalities, particularly when with reference to pension liabilities. Now, all of these are negative issues, but on the positive end, we've seen state tax revenues and municipal tax revenues in general slowly rise. Now, whether they be from income taxes or sales taxes or other sort of fee-type income, most revenues have recovered a little bit, and these cash or revenue streams have been steadily improving. So the financial health of most issuers, at least in current terms, has been improving over the past few months. But that's not necessarily reflected in the market. In fact, that market prices appear to be driven a lot more by the general conversation, which is very much negative on munis right now. We've created from Google Trends a little plot of the number of mentions, the number of times municipal bonds that is used as a search term on Google, and it's kind of interesting because you'll see that it's not a very common search term until early 2008, and there are these two spikes around the time when Bear Stearns collapsed and then when Lehman collapsed, and then you'll see once again towards the tail end of 2010, as there's a lot more talk of munis, there are more searches of munis, so very much in the news again because of this discussion of state budget deficits. So what do we offer clients or prospective clients who are interested in municipal bond portfolios? Probably the most important thing that we do is last on this list. It's a credit analysis that we conduct prior to purchasing any bond, and that includes a review of ratings of the issuer, its other bonds outstanding. We review the issuer's financials. We also do a review of the offering documents so that we understand the bond indenture and the rights of bondholders, the remedies available to them, and whatever assets are backing the bond or revenue streams are standing as surety for principal and interest payments. So we want to understand in a comprehensive way the financial condition of the issuer who will be making the interest and principal payments we're going to rely on. We also review regional demographics because most municipal bonds have some degree of geographic risk. There's concentration. They're linked to a particular locality, so we feel it's important for us to understand demographic and economic trends as they pertain to that local area. And that's one of the reasons we tend to recommend national muni bond portfolios to virtually every client. We know there's a little bit of state tax benefit that many clients might give up, but we feel it's more than compensated for by managing by helping manage the geographic or credit risk to any particular area or state or issuer. Our portfolios tend to be or are customizable for each client. We can take state tax considerations into account, and we can also take into account cash flow needs that a client has. In general, we take a pretty active view towards managing duration and maturity. So for instance, right now we are pretty short duration because we feel we're at a point in the rate cycle where rates should move up, and we do not want to be caught with very long duration or very long maturity bonds when that happens. We also feel like within the next 2 to 5 years there will be more attractive investment opportunities available to investors. So with that concludes sort of the overview and review of present conditions in the muni bond market. We've got some disclaimers that that should be on your screen right now, and we're also going to discuss a couple of questions that we received via email earlier this week.